Imagine you open your banking app right now and your balance reads $50,000. You feel secure. You've saved. You've been responsible. You've done everything the financial advisors told you to do. But here's what they didn't tell you, that $50,000 is a claim on a system that's already spent it 3 times over. Every dollar in your account exists because somewhere, someone borrowed 3 more into existence. And the cost of servicing all that borrowed money just crossed $1 trillion a year. That's not your debt. That's just the interest payment. The year is 2025, and the United States government now spends more money paying interest on old debts than it spends on the entire military that supposedly guarantees the dollar's value. Think about that equation for a second. The asset defending the currency costs less than the liability destroying it. But here's what makes your $50,000 particularly interesting right now. Half of all U.S. government debt, nearly $20 trillion worth, has to be refinanced by 2026. That means the Treasury Department must find new lenders willing to roll over old loans. And every 1% increase in the interest rate costs $70 billion annually, about 10% of the entire defense budget, just in additional interest. Your financial advisor called government bonds risk-free. He said cash was safe. He promised that diversified portfolios would protect you. But there's a 75-year pattern in economic history that repeats with the regularity of a heartbeat. It has 7 stages. Stage 1 starts with sound money and low debt. Stage 7 ends when the cost of paying yesterday's debts devours tomorrow's possibilities. We are in stage 7, and your $50,000 is about to learn a lesson that Weimar Germany taught in 1923, that Rome taught in the 3rd century, that every empire in history learned the hard way. The question isn't whether the system resets. The question is what your money will be worth when it does. Let me show you the number that should keep you awake at night. In October 2025, America's federal debt crossed $38 trillion. Write that out. $38,000 billion. That's 38 million millions. But here's the part your financial advisor won't explain to you. This is just the federal government's tab. It doesn't include state and municipal debt. It doesn't include corporate debt. It doesn't include the mortgage on your house or the balance on your credit cards. When you add up everything that everyone owes in the global economy, the number hits $251 trillion. The International Monetary Fund documented this in their 2025 Global Debt Monitor. 251 trillion represents 235% of the entire world's economic output. Every single person on this planet, all 8 billion of us, theoretically owes $31,500 before we're even born. A newborn baby in Mumbai, a pensioner in Munich, a farmer in Manitoba, all of them underwater from day one. But here's what makes this number truly dangerous. It becomes impossible to service at current interest rates. For years, maybe decades, you heard the experts on television explaining why none of this mattered. Debt doesn't matter when interest rates are low, they said with confident smiles. Governments can always print more money, they promised during every crisis. Look at Japan. They have debt at 230% of GDP, and they're fine, they claimed while ignoring that Japan hasn't raised interest rates in 30 years because doing so would trigger immediate default. The Federal Reserve, that institution that controls the printing press for the world's reserve currency, expanded its balance sheet from under $1 trillion in 2007 to $9 trillion by June 2022. That's a 900% increase in 15 years. They printed 9 times more dollars into existence. The European Central Bank did the same thing. So did the Bank of Japan. So did the People's Bank of China. Together, the world's central banks created over $25 trillion in new currency in just 15 years. They called it quantitative easing because printing money sounded too much like what banana republics do before they collapse. Then something changed. In fiscal year 2022, the United States paid $497 billion in interest on its debt. By fiscal year 2024, that number hit $909 billion. That's an 83% increase in just 2 years. By fiscal year 2025, interest payments exceeded $1 trillion for the first time in American history, becoming the second largest federal expense behind only Social Security. The Congressional Budget Office, the nonpartisan agency that's supposed to give us the unvarnished truth about federal finances, projects that interest costs will remain above 3.2% of GDP every year through 2034. That's a level exceeded only once since 1940. And back then, we were paying off the debt from winning World War II. Now we're paying interest on decades of tax cuts, unfunded wars, and stimulus programs that stimulated very little except the debt itself. Stop and think about what that means for your life. The United States government now spends more money just paying interest on past borrowing than it spends on the entire military budget, the same military that enforces the dollar's status as the world's reserve currency through 11 aircraft carrier strike groups and 800 overseas military bases. Ray Dalio didn't discover the debt supercycle, he documented it. After studying hundreds of financial crises across 48 countries spanning from 1800 to the present, he found a pattern so consistent it might as well be a law of physics. The cycle lasts approximately 75 years, give or take 25. It begins with sound money and low debt. It ends with monetary system collapse and reset, every single time, no exceptions. The cycle moves through 7 distinct stages. Stage 1, sound money, low debt, healthy growth. Stage 2, debt-fueled prosperity as confidence rises. Stage 3, the bubble forms when everyone extrapolates good times lasting forever. Stage 4, the bust arrives, usually when interest rates rise or debts can't be repaid. Stage 5, depression sets in and interest rates hit zero. Stage 6, central banks start printing money and buying assets because conventional tools no longer work. Stage 7, the endgame, when printing money itself stops generating growth and the system must reset. The current cycle began in 1945 at Bretton Woods, when the post-World War II monetary order was established with the dollar replacing gold as the anchor of global finance. We're now in year 80 of this cycle. The previous cycle ran from approximately 1870 to 1945, ending with the Second World War and the final destruction of the classical gold standard. Before that, similar patterns played out during the Napoleonic Wars era from 1790 to 1815. Every empire, every currency system, every debt-based economy follows the same script. You can see the entire arc in U.S. interest rate history. In 1981, the federal funds rate peaked at 20% when Paul Volcker was fighting double-digit inflation by deliberately crushing economic activity. Through the 90s and 2000s, rates fell steadily as debt grew, and each economic recovery became weaker than the last. In 2008, rates hit 0% for the first time in American history, the classic Stage 5 depression response. From 2009 to 2015, the Fed's balance sheet exploded from $900 billion to $4.5 trillion, a 400% increase in 6 years. They tried to normalize rates from 2015 to 2018, managing to reach 2.5% before the economy started showing stress fractures. In 2019, a mysterious repo crisis forced the Fed to inject emergency liquidity into overnight lending markets. By 2020, rates were back to zero, and the balance sheet exploded to $9 trillion as COVID provided the excuse for the largest money printing operation in human history. Then came the inflation nobody in power saw coming, despite dumping trillions of newly created dollars into the economy. The Fed raised rates to 5.5% to fight inflation that peaked at 9% in 2022. But here's the critical detail. They couldn't raise rates any further without triggering a debt crisis. Every boom for the past 40 years needed lower interest rates to get started. The 2001 dot-com bust required 5% in rate cuts. The 2008 financial crisis needed 5% in cuts, plus $4.5 trillion in money printing. The 2020 COVID crisis needed 1.5% in cuts from an already low 2.5%, plus another $4.5 trillion in printed money. Each recovery became weaker. Each crisis required more intervention. Each intervention produced less growth. And now there's nowhere left to cut. We're clearly in late stage 6, transitioning rapidly into stage 7. The crisis crystallized on October 23, 2025, when U.S. debt crossed $38 trillion. But the real horror lies in what happens next, the interest payments that compound the trap. Watch how the numbers accelerate. Fiscal year 2022, $497 billion in interest. Fiscal year 2023, $659 billion. Fiscal year 2024, $909 billion, an 83% increase from just 2 years earlier. Fiscal year 2025, over $1 trillion, exceeding defense spending for the first time in American history. At this trajectory, interest becomes the largest federal expenditure by 2026, larger than Social Security, larger than Medicare, larger than defense. The Congressional Budget Office projects interest costs will consume 3.2% of GDP or more annually through 2034, with the cumulative deficit adding $20 trillion over the next decade. $20 trillion. That's more than half the current total debt piled on top in just 10 years. Here's why this matters to your retirement account, your savings, your future. Half of all outstanding U.S. Treasury debt matures by 2026. This isn't optional debt that the government can choose to pay down slowly. It must be refinanced. The government must issue new bonds to pay off old bonds that are coming due. In fiscal year 2023 alone, Treasury refinanced $7 trillion in maturing debt. Every percentage point increase in interest rates on that refinanced debt costs $70 billion annually. $70 billion per percentage point. That's roughly 10% of the entire defense budget, the cost of 12 aircraft carriers, just for 1% more in interest on debt that already exists. Think of it like a homeowner with an adjustable rate mortgage. When rates were 2 to 3%, the monthly payment was manageable on a decent salary. But when rates hit 5.5% in 2023, that same debt doubled in servicing cost. The principal didn't change. The house is still the same house, but the monthly payment became unsustainable. Now multiply that dynamic by trillions of dollars and add the fact that the government cannot reduce spending in any meaningful way because Social Security, Medicare, and defense are politically untouchable, consuming over 2/3 of the budget before you even start talking about roads, schools, or anything else. Let me show you the revenue versus expense reality that makes this unsolvable under current policy. Fiscal year 2025 federal revenue, $5.2 trillion. Fiscal year 2025 federal spending, $7 trillion. Annual deficit, $1.8 trillion. Interest payments, $970 billion, which represents 19% of all revenue collected and 14% of all spending. By 2034, the Congressional Budget Office projects debt will reach 116% of GDP. Nearly 1 in every 5 tax dollars collected now goes exclusively to interest payments on past borrowing. That money produces zero economic value. It builds zero infrastructure. It funds zero services. It educates zero children. It defends zero borders. It's pure financial waste, the cost of decades of consuming more than we produced and promising more benefits than we could afford. The developing world faces an even bleaker picture. Developing countries paid $921 billion in net interest in 2023. 45 countries now spend more on interest than on healthcare. 22 countries spend more on interest than on education. Many pay 6 to 15% interest rates on dollar-denominated debt, while watching the dollar strengthen and rates rise globally, creating a debt service crisis that no amount of austerity can solve. Then came the signal that should terrify anyone paying attention. In December 2025, the Federal Reserve stopped quantitative tightening entirely. They'd been trying to shrink their balance sheet from $9 trillion back toward normal levels, but by October 2025, bank reserves fell below $3 trillion. Fed Governor Christopher Waller had stated the minimum safe reserve level was around $2.7 trillion. The Fed faced a choice: continue shrinking the balance sheet and risk a repeat of the 2019 repo crisis, or worse, or stop tightening and accept that the balance sheet stays permanently bloated at $6.6 trillion. They stopped. When debt becomes unsustainable, history offers only 3 exits. None are pleasant. All have been tried. The choice isn't whether one occurs, it's which one occurs and who pays the price. Exit 1 is outright default or debt restructuring. This isn't theoretical speculation. Sovereign defaults are routine throughout history. Carmen Reinhart and Kenneth Rogoff documented that countries have defaulted on their debts more than 250 times since 1800. Argentina has defaulted 9 times since independence, most recently in 2020. Greece required 289 billion euros. in bailouts from 2010 to 2015, and implemented voluntary haircuts where bondholders accepted 50 to 70% losses on their investments. Russia defaulted in 1998, wiping out $40 billion in domestic debt overnight. But the United States, China, and Japan are different. They're reserve currency issuers or hold massive foreign exchange reserves. They borrow in their own currencies, making outright default technically unnecessary, which just means they'll choose Exit 2 or Exit 3 instead. Exit 2 is hyperinflation and currency debasement. Post-World War I, Germany provides the blueprint that every economic student studies, but every central banker claims won't happen to them. Germany's war debt stood at 156 billion marks in 1918. Reparations added another 50 billion marks. Unable to raise taxes sufficiently and unwilling to slash spending, they printed money to pay the debts. The exchange rate went from 4.2 marks per dollar in 1914 to 4.2 trillion marks per dollar by November 1923. Inflation hit 29,500% per month at its peak. Domestic debts were wiped out, savings were destroyed, and political upheaval followed. We've already started down this path. The Fed's balance sheet expansion from $900 billion in 2008 to $9 trillion in 2022 was money creation on an unprecedented scale. The M2 money supply grew from $8.5 trillion in 2008 to $21.7 trillion in 2024, a 155% increase. Yet officials insist this isn't money printing. It is. They're just printing it digitally instead of running physical printing presses. Your dollar lost 20 to 25% of its purchasing power since 2020. That's a hidden tax on every dollar you saved, every fixed income investment you made, every wage you earned that didn't keep pace. Exit 3 is financial repression, the stealth default. This is how the United States actually dealt with World War II debt. Keep interest rates artificially low, below the inflation rate. Force banks, pension funds, and insurance companies to buy government bonds through regulation. Inflate the currency at 4 to 6% while bonds pay 2 to 3%. The result? Bondholders lose purchasing power annually while the government's debt shrinks in real terms without the dramatic headlines of default. U.S. debt stood at 106% of GDP in 1945. By 1980, it had fallen to 31%, not through paying it off, but through 35 years of negative real interest rates that slowly taxed savers and transferred wealth to the government. We're living through financial repression right now. The abstract numbers become personal now. 38 trillion in federal debt, 251 trillion globally, 1 trillion in annual interest payments. These aren't just statistics for economists to debate on cable news. They're a direct claim on your future income, your savings, your retirement security. If you're 65 or older, you've lived through the entire debt supercycle. You remember when the dollar was backed by gold until 1971. You remember 20% interest rates in 1981 when your savings account actually paid you to save. You watched the 2008 crisis destroy $19 trillion in household wealth overnight. You saw COVID stimulus checks add $5 trillion to the debt in 2 years while your grocery bill doubled. And now officials tell you everything is fine while the government spends $970 billion annually just on interest, producing nothing, building nothing, defending nothing. Here's what this means for your life specifically. If you're retired and living on fixed income, your $50,000 in annual retirement income loses 3 to 4% of its purchasing power every single year under the new normal inflation regime. Your bond portfolio generates negative real returns after inflation and taxes are accounted for. Social Security cost of living adjustments lag actual inflation because the government uses a manipulated consumer price index that systematically understates real price increases in healthcare, housing, and food, the things you actually spend money on. Medicare and healthcare costs rise at 5 to 7% annually, faster than general inflation and far faster than your fixed income grows. For savers, cash and bonds have become wealth destruction vehicles. A 4% Treasury yield minus 3% inflation minus your 22% marginal tax bracket equals a 1.1% real after-tax return. That's not wealth building. That's wealth erosion with a fancy financial statement. Money market accounts barely keep pace with inflation. Certificates of deposit lock you into guaranteed purchasing power loss for years. For every American, regardless of age, the implications are inescapable. Taxes must rise because the arithmetic demands it. You cannot service $1 trillion in annual interest, plus fund Social Security, Medicare, and defense on $5.2 trillion in revenue while running $1.8 trillion deficits forever. Government services must be cut because there's no other option when interest consumes 19% of revenue and rising. Inflation remains structural at 3 to 5% as the new normal, not the 2% target the Fed pretends to pursue. Currency debasement accelerates as the dollar gradually loses its reserve status and the privilege to export inflation globally. Foreign adversaries see what's coming with perfect clarity. China has reduced its U.S. Treasury holdings from $1.3 trillion in 2013 to $775 billion today. They're diversifying away from dollars, accumulating gold, and building alternative payment systems. BRICS nations are actively coordinating alternatives to dollar dominance. In 2023, 23% of global oil sales used non-dollar currencies, up from just 5% in 2018. They see the endgame approaching. Your personal strategy must change accordingly. Own hard assets, real estate with fixed-rate mortgages that let you pay back debt with inflated dollars, commodities that hold value through monetary chaos, infrastructure that produces essential services. Own scarce assets, gold with its 8,000-year track record as money, Bitcoin representing digital scarcity, productive farmland that grows food regardless of currency games. Own income-generating assets, dividend-paying stocks in companies with pricing power, rental properties that adjust rents with inflation, businesses that can pass costs to customers. Diversify internationally because not all currencies debase at the same rate or on the same timeline. Avoid long-term fixed-income bonds that guarantee wealth destruction. Avoid excessive cash holdings that suffer the hidden inflation tax. Avoid government promises because Social Security and Medicare face inevitable cuts or means testing as the arithmetic becomes impossible. Most importantly, understand that the survivors of every debt crisis throughout history shared one critical trait. They owned real assets when paper assets collapsed.